Ladies and gentlemen, this is Vinay Uttam, your resident stock doctor, and welcome to a brand new episode of the Stock Doctor podcast. Now, you would have noticed straight away that I did not tell anything. I did not tell any themes of the topic. I did not tell any, I did not give a headline as I usually do. I just welcomed you straight to the show. And that is because this is a very, very special show. Stock Doctor turns 4 years old. Yes, that's right. We are celebrating the fourth anniversary of the Stock Doctor podcast. And before I say anything, all I want to do first is basically thank you all for all your love and support, for all the feedback, for all the suggestions that you've made to improve the show, to make the show better, to make the show bigger, and to essentially, reach it to a lot more wider audience. So first of all, from the bottom of my heart, I'd really like to thank you all and for all the love and support, and much love to you all. And I really hope that I can continue doing this for many more years to come. I hope this is not, I hope there's more anniversaries that I get to celebrate with you. Having said that, with that being said, with that out of the way, I also want to tell you that it's a very special episode. I'm not going to be doing much of the talking. I have a special guest to do the talking, and it's a guest that you've listened to last year when we celebrated the show's 100th episode and the third year anniversary. It was a double celebration. So and you all loved him. You all loved his take. And so he's happy to be back. He's happy to be back with us. And it's the guest for this fourth anniversary special is none other than Dr. Ryan Lemand, the co-founder and CEO of Neovision Wealth Management. You already know him. You already know him by now. But a little introduction before we go straight into the interview. Dr. Lemand is a PhD in financial econometrics from ENS France. He's a seasoned financial professional with a lot of experience as an investment manager and a financial regulator. He has a wealth of experience in fixed income, credit, quantitative asset allocation, and risk management, having managed significant portfolios of institutional assets in Paris, London, and New York. Dr. Lemand is very popular on LinkedIn. I'm a huge fan of his LinkedIn posts. It's a very insightful post. If you are somebody who has limited access to the likes of Bloomberg or Wall Street Journal or Financial Times or any of that sort, I would urge you to definitely follow Dr. Lemand. He didn't tell me to do this. I've been following him for years now, and he's an absolutely he posts very, very insightful quotes and comments and insightful posts regarding the market action across the world. So you'll have a big picture in mind as well. So I definitely would urge you to follow him. He already has a following of well over 40,000, and he regularly appears on media interviews as well. You'll get snippets of him if you follow him on LinkedIn as well. So, it's an honor and privilege for me to welcome him to the show. So without further ado, without wasting any more time, check out the interview, and I hope you enjoy them. Once again, thank you very much for all the love. Here's the interview with Dr. Ryan Lemand of Neovision Wealth Management. Welcome back, Dr. Lemand. Welcome back to the show. It is so nice to see you again. And welcome back on the special occasion of the Stock Doctor podcast celebrating its fourth anniversary. I remember 1 year ago, it was a double celebration, 100th episode, third year anniversary. We had you as a special guest. Our listeners absolutely loved you, and it's so good to have you back once again. Thank you for agreeing. Thank you for taking some of your time off your busy schedule to be here. So welcome back again, once again to the show.
Vinay, thank you very much for having me again. It's an honor, and time absolutely flies. I mean,
Yes.
the past year just flew. It's as if we had it just 2 weeks ago. So again, thank you very much for having me, and congratulations on the continued show.
Thank you very much. Thank you very much. And I look forward to our discussion today because it's a deja vu moment for me, simply because the topics that we are discussing, essentially, I don't know whether it's coincidental or whatever it is, but again, it is so similar to what we discussed 1 year back, except the fact that some roles are reversed. So essentially, I'll get into it. So, I don't want to waste any more time or get straight into it. So my first question is obviously about the Fed. Right? Last time you were on the show, we kicked things off by talking about what was then the most anticipated rate cuts in 20 years of US stock market or US Fed history, whatever you want to call it. And September's normally a jittery month, but it has not turned out that way this year. And that is because the Fed's recent decision although it was not as important as it was last year. In fact, I'll just basically say that it was probably the world's worst kept secret at the time, the Fed's recent decision of cutting rates. So, the difference this time around is that markets back then were 1 year ago were expecting a 25 basis point rate cut. They got a 50 basis point rate cut. This time, some pockets of the market were expecting a 50 basis point rate cut. They got a 25 basis point rate cut. So I'm going to make it very simple. It's the same question, but but it's just 1 year later. Fast forward one later. What's your take on Fed Chair Jerome Powell and company's decision to cut rates by 25 basis points?
I want to go to years ago when President Trump in his first presidency has appointed Jerome Powell.
Yep.
So it was President Trump who appointed Jerome Powell as part of his political administration.
Some people forget that. Some people do forget.
Yes, yes. While noting a very, very important point, the Federal Reserve in the US has been created as a completely independent institution. It's an institution that should be completely immune, segregated, isolated from political pressure and political positioning, whether Democrats or Republicans. Let's note that, okay? Now, Jerome Powell, as an economist, I had quite a few remarks on him. I did criticize him on multiple TV interviews I've had, especially with his handling of inflation when it spiked initially.
Whereby the infamous transitory comment, as they
yes, where he labeled it. I think Jerome Powell was very hasty in labeling it as transitory, and it was obvious it wasn't transitory.
Yeah.
I mean, it didn't take a rocket scientist or a Nobel Prize in economics to figure out it wasn't transitory. So I think Jerome Powell did it, I think for political reasons or other reasons, I don't know, but that was a major mistake he made. Now, what followed later on proved that actually Jerome Powell is actually much better than I estimated. And he did stand up to the political pressures of President Trump by not cutting rates months ago.
Yeah.
The numbers did not warrant a rate cut. Even now in September, the rate cut, I do not think that data warrants the rate cut that we've seen.
Okay.
Because basically, if you look at the jobs market, a lot of things are changing the jobs market.
Yep.
And this has been shown through the very massive corrections or revisions that the BLS have made.
The BLS chair got fired as well as a result.
Yeah. So the BLS revisions, for me, are absolutely shocking.
Yeah.
I have not seen something like that even in developing or emerging countries,
Exactly,
what is called third world countries.
What was it, 30,000 jobs added in reality when initially they said more than 100,000 or something along those lines?
There was a revision of 900,000 even.
Exactly.
I mean, these revisions are just astronomical. Nothing justifies it.
Yes.
There's nothing I can think of that justifies these revisions. Now, had we been in a very sudden recession, had we been in another pandemic where things are very choppy and shocking, then yes, I would understand these revisions. Everything was like completely flat. Nothing surprising was happening. There were no black swans out there.
Yeah.
So these revisions, I don't understand them. So when the Fed basically has done a U-turn on its policy just based on jobs, I don't understand. Because at the same time, let's look at inflation. And I'm giving you the long answer to your question.
Yeah, no.
Let's look at the inflation. Many people look at headline CPI. We don't look at headline CPI. We look at how the contributing elements of CPI.
Yeah.
So if you look at the CPI, the latest print, 72% of the CPI components are growing at a rate higher than 2%, which is the Fed target.
Yeah.
So
exactly.
If you look at that graph of the components of the CPI contributing to a growth of more than 2%, this graph is actually going up since a few months.
Yeah.
So clearly inflation is coming back, which is totally expected in the United States, since the history of the United States.
Environment, yes.
Since the history of the United States, we have never had one inflation spike. It's always three spikes. The first one, the second one, and the third one. And it started digressing. And then this is why Volcker in the 80s has fought it with interest rates up to 19%.
Chair Powell's role model, supposedly.
Exactly. So why is inflation very, very important, in my opinion, way more important than jobs? Inflation erodes value substantially. Okay,
Correct.
inflation is like cancer for me.
Yeah.
You need to fight it with everything you have, because if you don't fight it, and you get into the business cycle turn,
Yeah.
and we are starting to see the business cycle turn in the US,
Yeah.
you might get into stagflation, which is the absolute nightmare for any economist or policymaker. Okay,
Yeah.
stagflation is something that is very difficult to exit. So that is why, for me, you extinguish inflation as soon as you can, and before the business cycle turns.
It's been a while since the US has had stagflation, right? It was in the 70s, wasn't it? When the Walker time,
Yes,
is it? Yeah.
yes, because you've had very strong policymakers and
Yes.
Fed
Yeah.
Fed chairmen who were very strict with their policies. Now,
Yes.
if you look at the current business cycle in the US, I think it's the longest run of positive GDP growth for a long time, if you
Correct.
exclude the
Yes.
pandemic. Okay,
Yeah.
so it's time for the business cycle to turn, knowing that business cycles are absolutely essential for any developed country. Uh, to have business cycles running around up and down, because this is how you flush from the system zombie companies. You flush out frauds like Bernie Madoff. If we didn't have the 2008, no one would have discovered Bernie Madoff.
Exactly.
So business cycles are very, very important to clean the system.
Yeah.
This is how the system flushes out everything that is bad and weak.
Yeah.
And the US now needs
I
that
mean,
that business cycle to turn
oh,
to flush it out.
yeah.
So to go back to the Fed, the decision for me, uh, I'm not going to say if it's good or bad. Maybe if it's a bit early, and we have seen two Fed board members, Musallam and Bostic,
Yes.
saying we might not need another interest rate
Yeah,
cut
it
before
was
the
more
end
of
of
a
the year.
precautionary move. I remember I was reading, Governor Bostich's statement. I think he was saying it was more precautionary move, and he doesn't see the need for rate cuts. Which actually brings me, automatically to my follow-up question on this, because I'm a fan of your LinkedIn posts. I don't know
Thank
whether
you.
you know this. I basically, it's part of my knowledge gathering mechanism nowadays. Like it's in your
Thank you.
post. So thank
I'm
you very
flattered.
much. So keep sharing them as they come along, is what I would say. So earlier this week, you made a very interesting post about the latest US jobless claims data, which is again going back to the date whereby, I don't want to misread. So I'm just going to read it straight away. You said the combination of initial jobless claims showing renewed volatility and then continuing claims continuing to remain elevated, hovering around multi-year highs. And you mentioned that if this combination persists, so you have initial jobless claims plus continuing claims, the combination that is that if this combination persists, then it could reinforce expectations of further monetary easing, though the Fed may remain cautious, balancing risk management with inflation concerns. Something that Chair Powell was very, very clear in his press conference about the importance of risk management. So it's I know the answer, but it would be lovely to hear you take. Which side of the pendulum are you on? Do you think the tariffs, like Fed Governor Stephen Mirren mentioned recently in a CNBC interview, won't be as inflationary? I mean, Governor Mirren, whatever reasons, where he may have, I think you and I both know this, won't be, he mentioned that the tariffs are not going to be as inflationary as what the other governors think, which means all the focus would then be on the weakening labor market, which would mean further cuts because the labor market is weakening, as we say. Or do you think this is a one and done environment like Governor Bostich did mention, and the Fed should wait and watch how the tariff picture plays out, where the focus remains on inflation?
Well, even Jerome Powell, in his speech during the Fed meeting now in September, he did say it was a risk management interest
Yes.
rate cut.
Yeah, it
Okay,
was his favorite. In fact, the media captured it as that was the theme, like risk management, risk management, risk management. Yeah.
so it's not ongoing policy. Why? Because Mr. Mirren said that tariffs will not be inflationary. Well, Mr. Mirren might need to rewrite economics books and go to university and teach students something else. Tariffs are inflationary, period. Theory and practice says that. I'm
Yeah.
not going to elaborate, okay?
I think what he was trying to say is maybe it was not going to be as inflationary as today as the Fed's projections are persisting. I think that's what I think he was mentioning in the interview. That yeah.
The thing is, tariffs' effect on inflation is delayed. There's always a big lag.
Yes.
It's not a short lag. It's not 3
Yeah.
or 6 months. It's longer than that.
Yeah.
Combine it with my earlier point that 72% of CPI components are contributing of an inflation
Mm-hmm.
higher than 2% at the moment, and
Mm-hmm.
since a few months.
Mm-hmm.
Combine the two, then yes, inflation is coming back,
Yeah.
period.
Yeah.
Combine it with jobs being weak
Yeah.
on the surface. Okay, why am I
Mm-hmm.
cautious with jobs? I'm going to say in a second.
Mm-hmm.
Combine these two. Well, we are heading towards forces that are pushing inflation up and an economy that is slowing down. I call this stagflation.
Stagflation. Stay up.
Okay.
The
Now,
dreaded
why am I
word.
cautious about jobs? I'm cautious about jobs because President Trump, parallelly to everything else, his immigration policies are very, very strict. And
Mm-hmm.
we've seen it with the H-1B
Yeah.
visa, for
The
example.
100,000 fee. Yep.
This is completely changing the jobs market in the United States.
Yes.
Okay, people willing to work, people exiting the workforce, etc.
Yeah.
So all of these percentages, because we look at jobs with percentages
Correct.
rather than absolute terms,
Yeah.
all of this is changing at the moment. The workforce in the United States is changing as we speak. Okay,
Yeah.
so it's not yet sure. I have a question mark on the jobs market. The third point is the following. So the aim of President Trump, this whole policy that he's adopting with regards to the workforce, the visas, etc., is to bring back manufacturing to the United States. Correct?
Yes.
We all
Yeah.
know that.
Yeah.
Now, in a recent poll done by the Financial Times, they asked, it was a big poll done and specifically on Republicans in the US,
Yeah.
okay? The popular base.
Yeah.
They asked them, would you like manufacturing jobs to come back to the US? So what did most of these Republicans answer? 82% of them. What did they answer? Yes or
I'm
no?
I'm assuming no. Is it?
They answered yes. They want
Okay.
manufacturing
Oh
jobs
yeah,
to
for the
come back to
popular
the
base.
US.
Yeah. Yeah.
Yeah,
Yeah.
this is what President Trump, this is what the
Yeah.
Republican base
Yeah.
of President Trump wants.
Yeah.
Manufacturing jobs to come back to
Yeah.
the United States.
No, I thought it was a trick question that you were asking.
No, the trick question is coming now.
Okay.
The second question in that poll is, would you be willing to work in a factory if this manufacturing job comes back to the US? 22% answered no.
Yeah.
So we want manufacturing jobs to come back to the United States,
Yeah.
but Americans don't want to work in a factory.
Exactly.
So this is my problem with the jobs market in the United States right now.
Yeah.
Is going through this transitional, very awkward phase
Yeah.
where I don't know which direction it's going to go because
Yeah, because
on,
it's a lot of question mark, right? When you have conflicting signals, right? Yeah.
yeah. So on one hand, you have President Trump taking very, very tough decisions with regards to immigration, jobs, putting illegal immigrants on planes, and
Yeah.
illegal immigrants, we all know in the United States, they do the low skilled jobs, cleaning pools,
Yes. Yeah.
housekeeping. And they're essential for any economy in the world. Not a single economy in the world has managed to eradicate illegal immigration with regards to low skilled jobs. When an
Yes.
immigrant is sitting in the street or stealing, yes, we have to have very harsh reactions with
Yeah.
these individuals. But when they're contributing to the economy, and many of these developed economies, they are tolerated
Yeah. Yeah.
with the purview that they will actually apply for a visa and make
Yeah.
themselves legal.
Yeah.
You don't just put them on a plane and throw them out. So combine these very strict actions that President Trump is doing.
Yeah.
With the weird composition of the jobs market at the moment in the United States, I have a huge question mark. I do not know, and I don't think anyone knows, even the BLS, in which direction the jobs market is going to go in the United States.
Yeah, I mean, especially with BLS looking at surveys and so on, which are always they come with a lag as well, right? So it's and then on top of that, we don't know the full picture right now, as you say. Like,
if you tell me where would the US economy weakness or recession will come from,
yeah,
my answer will be it's not the jobs, it's the consumer. The consumer has always been the cornerstone of the US economy. It's a consumption-based economy. Now, if you look at consumption numbers, on the surface, they look amazing. Consumption, retail consumption is looking good.
I mean, based on the stock markets, that's what they would say. You know, the US consumer is strong. US consumer is strong is like the mantra of these, the ones who come on, the analysts and the experts. Yeah.
No, but even exclude the stock market. Durable and non-durable consumer spending is quite healthy.
Exactly.
But again, we don't look at the headline number. We have to drill down. Look at the drill down. Where is this consumption coming from? It's coming from high earners. If you look at middle class and low income consumers, Actually their consumption is going down.
I think it was a point raised by companies like Walmart, right? Which is the bellwether
Thank
of
you.
the US consumer. Yeah.
Exactly. And it's these guys who have mortgages, who have credit cards, who have revolving debt. If these guys start defaulting,
Yeah, big.
and yeah, the US is in a big trouble from a
Yeah.
consumption perspective. And this is when the US would enter into what I would welcome as a recession. Because the
Yeah.
US needs a recession today. Recessions are not bad. Recessions fundamentally are not bad. So when unemployment jumps to 6 or 7%,
Yeah.
it's not the end of the world. People who lose their jobs are people. Okay, I as a company, I run a company.
Yeah.
If I want to fire someone, would I fire my best? No,
Yeah.
I'd fire people who are not performing well, who are at the bottom when the economy turns around.
Yeah.
So people who lose their jobs are people who need to upskill, people who need training, people who need to improve their skills and work harder.
Yeah.
This is where unemployment comes from. Recessions and unemployment rising is not necessarily a bad thing. Because yes, we look at 7-8% unemployment. Let's not forget 92% are actually still working.
Yeah. Yeah. I still remember the panic in the markets when unemployment rate went from 4.2 to 4.3%. And people would be like, oh boy, it's got, and I said, that's a 0.1%. I was talking to some of my friends as well. I think, and they were talking about the US markets, and they were essentially saying, oh, I don't know why the markets are going up. The unemployment rate just went up. And I said, that's a 0.1%,
Yeah.
increase. So imagine if it goes up to, let's say, 7, 8, which I also agree is not as bad as doomsday, predictors
Yeah.
predict, as to say. Yeah. So I think that was a very interesting take on the US job market. I just want to move. I mean, it's the last question on the Fed that I have, because now that I have you, I have to take, I have to ask for your take. I know you in a CNBC Saudi Arabia interview last week, you hinted that you find that the rate cut in this environment risks looking like political accommodation ahead of an election cycle.
Yeah.
So I'm just going to make it very straightforward. Do you think the Fed's independence, in your opinion, is compromised? And,
Absolutely,
and should,
100%.
should we be worried as
Absolutely.
investors? Yeah.
Yes, Jerome Powell is trying to defend it. Some Fed board members are trying to defend it. It's obvious. But if you look at the decision that was taken 11-1, which
Yeah.
shows consensus, but
Yeah.
when you look at the dot plot, it doesn't
Oh,
show
yeah.
consensus. The dot plot is like pulled vertically. Okay,
I think with
so
one, I think it's Governor Mirren calling for 5 more rate cuts. I mean,
yeah, and 50 basis points, and others are maintaining no cuts. And
yeah,
so you don't see consensus in the
yeah,
dot plot. So clearly, politics have driven the consensus 11-1 vote that we've seen 2 weeks ago during the September meeting. Absolutely.
yeah.
Um, the second point is um, so if you look at Mrs. Cook, who's being
Oh,
chased,
yes.
the
Yeah.
witch hunt
It's a cook. Yes.
against. So for me, this is waving the stick to other Fed board members.
Yeah.
Okay. So if you don't do what I say, if you don't follow my political will with regards to Fed decisions, well, I'm gonna come up with some of the stuff you've made, the apartments you bought, or some of the insider trading you've
Yeah.
done. Okay. If he really wants to apply that, well, Nancy Pelosi should be in jail right now because, yeah, she's a
That was
policymaker.
that was literally my first thought as well when this thing came up. Like Nvidia trades, they call an Nvidia trade as a Nancy Pelosi trade these days. Yes.
And you can link a lot of the policies that have been adopted by the US Congress with the timing of Mrs. Pelosi's trades.
Yes.
I'm sorry, and the list goes on. I'm just
Yeah.
giving you the obvious, Mrs.
Yeah.
Pelosi, but there are quite a few.
Yeah.
Even President Trump in April, when the US stocks
Yeah.
dipped, and he made his famous
Post. Yeah.
social post where buy now. I
Yeah.
mean,
Yeah.
come on. When
Yeah.
he says outright in the White House, I've made these people rich in the stock market, this is an admission of guilt. I'm sorry. Okay.
Yeah.
So, yes, my answer is yes. There is political influence being exercised against the Fed to take certain actions. So, yes,
And how do you
I
think
put a question
investors
mark
should,
on it.
how do you think investors should basically like factor this? I mean, can it be factorable? Like, can it have, what is it just stay away from the US stocks?
Well, you know what? This is what we've done. So, in our model portfolio, our
Yeah.
model portfolio is up. I think we're gonna
Yeah,
talk about that.
I'm gonna talk to you about this. Yeah.
We're up 27% year to date with very, 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 very little US exposure. So
Yeah.
yes, we prefer to stay away.
Yeah, well, in that leads me straight to the next question then. Like basically, I wanted to congratulate you on this because 27% year to date, no mean feat, no small feat. It's an absolute amazing done. And the fact I read it that it's with no US risk exposure, especially in today's market when everybody's like buy Nvidia, buy buy Google, buy the Mag 7, so to speak. I think it's so. First of all, congratulations on
Thank you.
the model portfolio being up 27%. And you mentioned about your mantra is no US risk exposure and more of geographic diversification. So I have a two-part question essentially. So does that mean that you would, in your opinion, advise investors to stay away from the Mag 7, who are starting to show signs of new life again? Because 2 days ago, Nvidia, OpenAI, $100 billion deal, all of that is happening. There's a lot more positive sentiment. Apple has been the biggest surprise. Like it was lagging all through the year, and an iPhone 17 Air comes up, back to positive territory year to date. It's been on a flyer. So do you think that, given the momentum that is slowly creeping back into these Mag 7 stocks, do you think do you think you would still advise investors to stay away from the Mag 7? And the second part is the geographic diversification. I was very, very interested to know this because I was going to ask you which geographies do you like the most for the long term and any particular sectors as well. So yeah.
Okay. So on the first question on the Mag 7,
Yeah.
I'm not fundamentally against them. They are good companies. They're generating return, net income, growing. They're innovating. They're changing, etc. Okay. My problem is concentration risk. So today, the Mag 7, again, yesterday, they broke another record,
Yeah.
exceeding, I think, 36% of the S&P 500.
Yes.
This is terrifying.
Yeah.
So if we go back to any theory or practice in constructing a portfolio, it just tells you stay away, period.
Yeah.
Any model that you look at, it will tell you stay away. This is called concentration risk. This is high correlation. Okay.
Yeah.
So fundamentally, I'm not against them, but when you put them on a portfolio and a high proportion, it's affecting the whole risk of your portfolio. The way we construct a portfolio, we start with the risk budget, and every position we add, it consumes from that risk budget, and that risk budget is tracked in real time. So
Mm-hmm.
positions, they rise or fall,
Mm-hmm.
and the risk consumption of our risk budget.
Yes.
So if we had to put Max 7 in our portfolio, it would consume a big chunk of our risk budget and take away some very interesting diversification in other places that we can find in other geographies.
Yeah.
So our decision is not to go through this hassle because it's not Max 7.
Yeah.
The way we invest is basically top down and bottom up.
Yeah.
When you look at the US in general, with
Yeah.
all of the policy uncertainty, the Fed independence, jobs market question mark, so many things that I'm not going to list all of them. People know them.
Yeah. Yeah.
Add to it Max
But,
7.
but I think you put the top three very correctly, like the question
Yeah.
mark, the Fed independence. Yeah, it's yeah.
So risk is quite substantial, and it's not idiosyncratic, it's systemic risk.
Yeah.
So it's a conscious decision. You know what? No. Okay. Now, that being said, people look again at headlines. People look at Nvidia. Let me give you one example that I gave in a Bloomberg interview recently, and the anchor Jumana actually made the post about it on
Oh.
LinkedIn. Let me give you a company called Build-A-Bear.
Yep. Yep.
BBW, that's the
Yep.
ticker of it. Check it out. It has beaten Nvidia over the past 5 years. Completely beaten Nvidia.
Yeah.
And not because it's a meme stock. The company actually is doing well. They reinvented themselves. They're building small teddy bears that are directed at what we call adult kids, like people like us who have nostalgia to their kidhood, and they
Yeah.
want to buy these small teddy bears. And the companies did very well, and it has beaten Nvidia. There are quite a few stocks in the US that people can buy that beat Nvidia, that beat Meta, that beat Alphabet.
Yeah.
They have a very good fundamental model. They distribute dividends. So, and they do not contribute so much into the risk exposure in their portfolios. Just people have to look. People have to look beyond headlines and beyond what is called hype. I
Yeah.
hate hype.
Yeah.
I do not invest on hype.
Yeah.
I invest based on fundamentals.
Yeah.
Period.
Yeah. So, no, I think so. My listeners would be very, very happy. Build-A-Bear, they've got a stock idea straight away. Like, I normally do a Dr. Dissect segment, and then normally I talk about, Netflix, Alphabet, and so on. Today, we'll talk about, the teddy bears would really get them excited. And it's surprising that, I mean, it's not, it is very, it's not surprising and not surprising at the same time, that because it is surprising that you have companies underneath that are, that are not part of, especially in this AI revolution that we're going through. You have companies that are doing really well because, that are not part of that AI cycle. Like, I'm not just talking about the tech, I'm also talking about industrial companies and so on. And then you have a company like Build a Bear, that's just kind of, that has outperformed even the best of the best out there. And it is also not surprising because at the end of the day, it's the headline risk. Right? A lot of people are just focused on just headlines, and they forget that there are gems underneath the headlines as well. So I just wanted to touch upon the geographic
Yeah.
diversification as well, if we could. Which geographies would you recommend to the listeners for the long term, and any sectors in focus as well?
The first geography is a continent I call gold.
Oh,
It's a great continent.
we have a whole discussion on gold, sir.
We're gonna get to that. So it's the eighth continent of Earth. It's a stone. It doesn't pay dividends. It doesn't generate any income. But you know what? It has this fantastic effect on your portfolio. It anchors it down from a risk perspective, and it hedges you from all of the risks that we're seeing around the world at the moment.
Yeah.
Okay, that's the
Yeah.
first geographic
Yeah, we're going
diversification.
to talk a bit more in a
Sure.
bit about gold. Yeah, I've got
The second geographic diversification that is not based on stock picking, it's China.
China.
Okay, China stocks have been undervalued for quite some time,
Yes.
and I think we talked last year. We
Yeah.
went really all in on China since we talked,
Yeah.
and you know what? We're reaping the benefits right now. I
Oh,
mean,
no,
look
it's
at
fantastic.
look at Alibaba. Alibaba
Yeah.
is jumping 1% each day almost. I mean,
Yes.
it's fantastic.
Yeah.
Okay,
It's
the company is competing with Amazon. It's doing well. It's selling. So now the Chinese economy is facing issues from an
yes.
industrial production perspective, leverage, real
Yeah.
estate. Yes, the Chinese economy has quite a few challenges.
Yeah.
However, look at their announcement yesterday about gold storage, where it's
Yes.
inviting countries. You want to store gold?
I
You
remember
want
last year we were saying, I remember clearly that China was actually selling off gold, and I remember asking you the question. And now coincidentally, I'm telling you, just yesterday I saw the post. Now China's buying back in. So yeah, you're
Yeah, they're
absolutely
buying
right.
massive amounts.
Yeah.
They're out of storage place in Shanghai, by the way.
Yeah.
China is
Yeah.
out of gold storage in Shanghai. That's how much they're buying
Yeah.
gold. Okay. Now couple it with India.
Yeah.
India now has shaken hands with China,
Yeah.
and we're seeing the effects on gold,
Yeah.
on the reverse adoption of the US dollar,
Hmm.
on consumption, on side trade agreements,
Yeah.
and we haven't seen anything yet. I think
Hmm.
we're really in the beginning of the cooperation between China and India.
And
The US President Trump went completely frontal with India,
ballistic, I would say. Yeah, it's
yeah, on
50%
India,
tariff.
and
Yeah.
India has other alternatives,
Yeah.
and Mr. Modi has
Yeah.
shaken hands with China to
Yeah.
cooperate, and
Yeah.
I think that cooperation um, will change how we perceive the world.
Yeah.
So China first, India is
Yeah.
another geographic location, okay, whereby stocks have done very well. You have to do some stock picking in India because the market is massive.
Yeah.
But yes, India is another powerhouse that is emerging.
Yeah.
Okay. And Asia in general, you have a lot of opportunities in Asia. Let's not forget, Asia is 3.2 billion consumers,
Correct.
3.2 individuals. Now, if you look at per capita consumption, it's a fraction of US consumers. Granted,
Yeah.
I say that, but I look at growth. I don't
Yes.
look at in the absolute terms per capita.
Yeah.
The way the per capita consumption is growing in Asia is
Yeah.
phenomenal.
I think
I mean,
India's Q1 GDP was 7.8%. So I
yeah,
think it was just surprised everybody. Like,
yeah,
as
yeah.
an Indian investor, surprised me to the positive as well. Like it was,
As an investor, I look for growth, not in
yeah,
absolute terms.
yeah,
Yes, the US is a fantastic country with a great consumption base, but I'm after growth, and
yeah.
growth I'm finding it in
And
in
not just
Asia.
growth for the future as well, right? It is like the future growth as well, right? Not
Yeah,
just, yeah.
yeah. Now, Europe, yeah, the old continent is facing huge, huge headwind.
Yeah.
Europe is transforming into a developing economy,
Yes,
what
yes,
we call an emerging country or
yeah,
emerging area, third world country, if you
yeah,
will,
yeah,
from a security, taxes, regulations, everything.
yes,
But there are still opportunities that
yeah,
can be picked up. So, for example, on defense, that trade
yes,
was defense.
I was going to say, I think
Ambition.
they've loosened their purses when it comes to defense.
Yes,
Yeah,
yes. So defense has done very well.
yeah.
There are some pockets of investment in Europe that can be picked up as well, but on a pure stock picking perspective.
Perspective, yeah. So you're going mainly it's China, India, and then pockets of Europe from a pure stock picking perspective.
Yeah. Now within Europe, Switzerland,
Yeah,
I'm a big fan of Swiss stocks. It's one of the most stable economies in the whole world.
yeah,
It Switzerland has isolated itself from Europe.
yeah.
It's not part of the EU, thankfully.
Yeah.
And I myself personally, this is not investment advice.
Yeah.
My kids' college fund is all in Swiss stocks,
Oh, okay, okay.
all of it.
Yeah,
Okay, with some gold, obviously.
yeah,
So I'm getting dividends. It's stable. This is what I'm looking for on a personal level.
yeah, yeah, makes sense. Okay, yeah. So now we got to come. It's the last question. We're nearly the end. I can't believe time really flies when I'm talking with you. Like, but now we're gonna wrap it up with your favorite theme, gold. I have to. I told you, I cannot let you go without talking about gold because honestly, I've it is such a pivotal moment for the commodity as well. Like, so you've been like it's very clear you've been a big fan of gold for a while. We talked about in length last time as well when you were here, and you made a solid case last time for why investors should love gold. And I have to say, all those who listened to you last year would be laughing their way into the bank right now. I mean, it's up 40%
Exactly.
year to date, 40% all-time highs. Happy days. It's done a phenomenal job. So and yet you have not, I wouldn't say naysayers, but you have these sort of one or two, like not few, quite a few, that there's a growing voice who continue to basically double down, not double down, triple down on gold. And this is from a concentration risk perspective is the question that I wanted to talk to you. Like people like Jeffrey Gundlach of Double Line Capital, I was listening to his interview on CNBC on Fed Day last week. He said gold deserves a 25% allocation to one's portfolio today. I mean,
That's our allocation.
your allocation 25%
It's
even now.
25%.
Yeah.
Yep.
No, the reason because so I know you're a fan of gold trade, but the reason why I wanted to ask you this question was from a concentration risk perspective. Like, do you think there are high allocation warrants even at these levels, like all-time high levels? Or do you think
Absolutely.
people should trim some profits and maybe diversify a bit or into maybe other commodities? Like, yeah.
Yeah, okay. So this is not investment advice
Yeah.
again. We are betting on gold for multiple reasons.
Yeah.
One of the reasons is all the factors that have pushed gold prices up are still in place. Nothing has changed.
Okay. Okay.
One, political.
Yeah.
I'm going to do a parallel with oil in a second.
Yeah.
Second, not only political, but also diversification, because central banks, numbers show it, they are reducing their US dollar exposure and treasury exposure and replacing it by gold, one
Right.
for one.
Yeah.
Okay. And this numbers, public numbers are showing that.
Yeah.
Okay. And three, as a systemic risk reduction of the portfolio risk. Okay, these are the three main reasons.
Main rate.
Now, gold, what pushed it so high, the big component of it is political. And that political part, we have seen it with oil roughly 10 years ago. Okay, when
Yep.
oil spiked, went to 140, 150, 160,
Yes.
I think.
Yep.
This is when, if you look at the prices of gold back then, they were completely stagnant, going sideways.
Yeah.
Okay, because the political money was actually going to oil and not to gold.
Gold. Okay.
Oil was being used as a political tool back then.
Yeah.
And now, since the dynamics of oil has changed, since the US, let's not forget, became self-sufficient with oil.
Yeah.
Okay, so all politics, all
Yeah,
politics.
it's off.
And this is when oil prices completely stabilized. And in our opinion, we'll go into a price tunnel of $65 to $70. This is where it is right now.
Yeah,
Unless
it is.
we-
Yeah.
Unless we have a political shock or a geopolitics or a war somewhere.
I think the IEA was calling for $60 towards the end of next year as well because of OPEC releasing
Yeah.
more oil, isn't it? Yeah.
Yeah. So oil now, as you can see, price action has become very boring.
Yes.
Where did
Yeah.
political money go? To gold.
Gold.
Okay. And again, people should not forget 10 years ago what happened, oil versus gold. Okay. Price action with oil, boring gold, and now the other way around.
The other way around.
So all of these factors behind the gold price rise are still in place. The other part I want to talk about, just
Yeah.
very quickly,
No, please.
people should not look at the price of gold going up. They should see it the other way around. It's the US dollar's value that is dropping against gold.
Yeah.
This is how people should see it. So if people believe that the value of the US dollar will continue going down, that means the price of gold will continue going up.
So
this is how people should see
it's
it.
the flip side. So instead of looking
Yes.
at the price increase, it's the other one, the dollar, the sort of the factor that's balancing act essentially, isn't it?
Yes.
So so overall, would you think that it should continue to going up? Because if you look at it from the other perspective, dollar weakening, which a lot of people have called for, dollar will continue to weaken for a bit. So you would recommend that the gold would go up, continue keep going up.
Yes, and not only the US dollar dropping in value, also the purchasing power
Mm-hmm.
of dollar. If you
Yeah.
look at it over the past 50 years, it's a sliding graph like that. So
Yeah.
what could buy you X 50 years ago, now it buys you a fraction of that X.
Fraction. Yeah.
So it's the value purchasing power of gold. Both are dropping. So
Yeah.
this means gold is going up. Now, my story with gold goes back to when it was at $800. When we hit $1,000, you had lots of experts. That's it. It's over $1,000. Same thing when it hit $2,000. I
Yeah.
bought at 1,800, and I had lots of people criticizing, why are you doing that? When it hit 2,000, that's it. That's the cap. It will not go beyond. It crossed 3,000 and it will cross 4,000.
Yeah, it is. It's almost like I believe it closed around 3,700, another all-time record yesterday. So it was. So is there a point where
It's not a recommendation,
yeah,
but I'm buying gold.
go buy gold, and then you're going to maintain the 25% allocation.
Yes.
Yeah, okay,
Yes. Again, as long as the underlying factors are still in place.
still in place.
If tomorrow President Trump goes, signs magnificent agreements with China and India, it's all love and getting in bed together and everything is fine and dandy, then yes, this changes things.
Changes the game. Okay. All right, so there you go, listeners. You've got to continue. So let's see what happens next year. Like when we say, because last year with 40% return, whoever has followed you, and I'm sure our listeners will follow you in right into this as well. Thank you so much, Dr. Lemand, for doing this interview with me. It was an absolute pleasure to have you. Maybe we don't wait another year. Maybe I could invite you before that as well, just to talk, just to talk things through. And one thing's for sure, gold will definitely be in part as part of the conversation. But thank you very much, Dr. Lemand, to celebrate the show's 4th anniversary. Thank you for taking the time off. And
thank you for having me.
And I hope to see you again very soon. Thank you.
Absolutely. Thank you.
There you have it, folks. That was the interview with Dr. Ryan Lemand of Neovision Wealth Management. I really hope you guys enjoyed that conversation. I feel like he knew the format of the show when he basically did, he covered India. He even gave you a stock pick as well in terms of Build-A-Bear, which has been outperforming Nvidia the last 5 years. Who knew about that? So I do hope you do check out the company as well. And I really hope you gained some much insights into the US economy, the US political environment, how it's affecting the US economy and US investment. How it's affecting the US, US stock market per se, and the US economy as well. I hope you're going some very good insights on the likes of Switzerland, geographic diversification, how it's very important to diversify geographically if you are running a well-balanced portfolio. And of course, I really hope that you listen to his comments on gold, one of his favorite investments. It's been for a while. Last year when I asked him, like I said, it made an absolute killing in the last 1 year, continues to make all-time highs. So I hope you did pick up some insights on that as well. Next week, we'll be back to our regular format, which is going to be the usual 3 segments. It'll be me doing the talking mostly, so get ready for that. So overall, I really hope you enjoyed the interview. And once again, thank you very much for being with us here on this 4th anniversary special. And I really hope that, and thank you once again for all the love and support that you've given me. So without further ado, I will see you next week. Until then, stay safe and make some money.